You're a Roman citizen. It's 200 BC. You are standing in the market in Rome. In front of you, a man is being sold. There is a small wooden sign hanging from his neck. It lists his age, his origin, his skills, and something the Romans called defects. Underneath the sign, there is a warranty. If the man dies within 6 months, or turns out to be sick, or runs away, you can bring him back. The seller has to give you your money. This is the law. It is called the Aedilician edict, and it is one of the earliest examples of what would eventually become a much darker industry. Insurance on human beings. This sounds like something that would have ended with the Romans. It did not. The idea that a person could be inserted into a contract as property, warranted, priced, insured, would keep showing up in different countries for the next 2,000 years. And the biggest names in the modern insurance industry, names you have probably heard of, were legally required in the early 2000s to open their archives and admit exactly how much of it they had done. So how did insurance companies end up in the slave trade? And why is this history being disclosed only now, 2,000 years after the Romans first wrote the rules? The answer covers Roman market law, one specific court case in 1783 that helped fuel the abolition movement in Britain, an American industry that quietly wrote thousands of policies before the Civil War, and a Californian statute passed in the year 2000 that finally forced the archives open. Once you know the chain, you will see why insurance is not just about protecting things. It has also, at moments in history, been about protecting the ownership of people. Let's start with the Romans. Slavery in Rome was legal, enormous, and highly commercialized. Historians estimate that at the peak of the empire, 1 in 3 residents of the city of Rome was enslaved. The Romans built extensive legal machinery to manage the sale, purchase, transfer, and inheritance of enslaved people. Around 200 BC, the office of the aediles, the Roman market magistrates, issued a set of rules called the Edictum Aedilium Curulium. It required every seller of enslaved people in the Roman marketplace to disclose specific defects, illness, chronic conditions, a tendency to run away, a history of stealing. If the buyer discovered any of these within 6 months, he could return the enslaved person and demand a full refund. This action was called redhibitio. If the defect was smaller, the buyer could keep the person and ask for a partial refund. That was called actio quanti minoris. Roman law scholars still study these clauses today. They are among the earliest codified consumer protection rules in Western legal history. They were also, quite explicitly, protection for the purchaser of a human being. Here's where it gets uncomfortable. When the Atlantic slave trade began in the 15th century, the same legal logic that had been developed for Roman markets was extended to the sea. Enslaved Africans transported across the ocean were classified, legally, as cargo. Cargo could be insured. And so slave ships were insured. In 1781, a British slave ship called the Zong was crossing the Atlantic. The ship was overloaded, water was running low. The captain and crew made a decision that would end up in a British court. They threw approximately 130 enslaved Africans alive into the ocean. The reasoning behind the decision was cold and specifically legal. If the enslaved people died of thirst on board, that was a loss the ship's owners had to absorb themselves. If the enslaved people were deliberately jettisoned to save the rest of the voyage, that was general average, a well-established principle of maritime law going back to ancient Rhodian sea code. It could be claimed on the insurance. The Zong case, formerly known as Gregson versus Gilbert, was heard by an English court in 1783. The court did not treat it as a murder trial. It treated it as an insurance dispute. The insurers refused to pay. The abolitionist movement in Britain seized on the case within months. It became a rallying moment. The industry that had priced the lives of the enslaved suddenly became the industry that had exposed the horror of it. That contradiction would take another 50 years to resolve. Now here is the part that is genuinely difficult. In the United States, from the 1840s until the American Civil War, insurance companies wrote thousands of policies on enslaved workers. Not for the enslaved themselves. They were never the beneficiaries. The policies were written for the enslavers, insuring them against the death or injury of the people they held in bondage. If an enslaved man working in a coal mine died, the mine owner filed a claim. If an enslaved worker was hired out to a railroad and killed on the job, the plantation owner collected the payout. The premiums were paid. The claims were paid. The names of the enslaved people were entered into ledgers, usually only by first name, sometimes with no name at all. 4 companies, whose descendants still exist today, are known to have written these policies. The typical policy covered the enslaved worker for a term of 1 year. Premiums usually ran between 1 and 2% of the assessed value. Payouts were made to the enslaver if the worker died. The industry did not consider this ethically distinct from insuring livestock or industrial equipment. The paperwork treated it the same way. The math worked the same way. For over 140 years after the Civil War, this history sat quietly in company archives. Then, in 2000, the California legislature passed Senate Bill 2199, the Slavery-Era Insurance Policies Act, authored by Senator Tom Hayden. It required every insurer licensed in California to search their archives and disclose every slavery-era policy their predecessors had ever written. The reports came in over the next 2 years. Aetna disclosed 7 policies from the late 1840s to 1,860, and later a full ledger book with additional names. New York Life disclosed ledgers from Nautilus Insurance, including copies from 3 separate ledgers and its death claim book. AIG disclosed policies from United States Life. The California Department of Insurance published the Slavery-Era Insurance Registry in May 2002. It contained the first names of the enslaved people whose lives had been priced, insured, and profited from. In the 2010s, Illinois, Iowa, and Maryland passed similar disclosure laws. Here is why all of this still matters. The insurance industry did not just watch the slave economy from the outside. It provided part of the financial infrastructure that made slavery scalable. Without insurance on the shipment, the transatlantic slave trade was harder to finance. Without insurance on the enslaved worker, hiring them out to industrial employers was harder to justify economically. Without the aedilician edict, the Roman slave market would have run on unpredictable risk. Insurance is a mirror. It reflects whatever a society decides is valuable enough to protect. For most of 2,000 years, human beings were on that list. The disclosure laws of the 2000s did not undo any of this. They did not pay reparations. They did not restructure any company. What they did was pull the ledgers out of the archives and put them on the table. The first names of the enslaved people that Aetna disclosed. The names in the Nautilus ledgers. The names on the Zong. For most of history, these people had been listed as property, or as cargo, or as line items. In the 21st century, the industry that had priced them was legally required to say their names. So the Roman citizen in 200 BC, standing in the market, reading the wooden sign hanging from the neck of another human being, was doing something that would be repeated in different forms for the next 2,000 years. Priced, warrantied, insured. The specifics changed, the buyers changed, the ships changed, the countries changed, the law changed. But the underlying idea that a person could be inserted into a contract like a piece of property kept showing up, generation after generation, century after century, until enough people finally forced the industry to stop. There is a hard truth underneath every insurance policy ever written. Insurance can price anything. It has priced ships and houses and haircuts and voices. It has also at times priced people. That is not a technical accident. It is a moral choice made over and over by generations of underwriters who signed the papers because the numbers worked. The math is not what stops the industry from making the wrong choice. What stops it sometimes is other people making them stop. The aedilician edict is gone. The Zong is gone. The plantation ledgers are gone. The names, finally, are in the record. The registry is still here.